What if I told you the most dangerous financial moment of your lifetime isn't coming, it's already here? Not in 2 years, not after the next election. Right now, quietly, the economic architecture that most Americans have staked their retirement on is cracking at its foundation. I've spent 5 decades mapping economic cycles. I called the collapse of the dot-com bubble before analysts stopped laughing at me. I warned my clients about 2008 while Wall Street was still throwing champagne parties. And today, every single indicator I monitor is screaming the same message. You have roughly 18 months to reposition or face the consequences of doing nothing. This isn't pessimism. This isn't fear-mongering wrapped in financial jargon. This is pattern recognition. These debt cycles have played out before in the 1930s, in the 1970s, across 5 centuries of economic history I personally studied. The pattern doesn't lie, and right now it's pointing to a massive transfer of wealth. Not a dip, not a correction. A transfer from people holding the wrong assets to people who had the foresight to hold the right ones. In the next 20 minutes, I'm going to show you exactly what those 4 assets are. But first, you need to understand the machine. Most people think the economy is random. It isn't. It's a mechanism, and it runs on 3 interconnected forces. The first is productivity growth. Simply put, are we generating more real value per person this year than last? When that answer is yes, economies thrive. When it stalls, stagnation sets in. The second force is the short-term debt cycle, which typically runs 5 to 8 years. Credit expands, spending increases, inflation builds, central banks raise rates, borrowing slows, and eventually the economy contracts. Banks cut rates, and the cycle starts again. This is why recessions arrive every 7 to 10 years like clockwork. It isn't bad luck, it's the machine running its predictable course. But the third force is the one most people never see until it's too late. Beneath those short cycles runs a far longer, far more powerful current, the long-term debt cycle. Over generations, debt accumulates. Government debt, corporate debt, consumer debt. Slowly, year after year, like water rising in a basement, until one day, the debt load reaches a threshold where no combination of growth, refinancing, or economic optimism can make it sustainable anymore. That's the moment the machine doesn't just slow down, it breaks. According to publicly available data, total U.S. debt, federal, corporate, and consumer combined, has now surpassed $90 trillion. Federal debt alone sits at roughly $38 trillion, representing approximately 125% of the entire gross domestic product of the United States. More strikingly, the federal government now spends over $1 trillion annually just servicing the interest on that debt, more than the entire defense budget, more than education, more than infrastructure investment. When interest payments eclipse military spending, the warning sign isn't subtle. The machine is reaching its limit. When a long-term debt cycle reaches this stage, only 3 paths exist. The first is outright default. Governments and institutions stop honoring their obligations, triggering cascading financial destruction. The second is restructuring. Creditors accept partial repayment over extended timelines, which sounds orderly until you realize those creditors are pension funds, savings accounts, and retirement portfolios. The third path, and the one that central banks have chosen every single time throughout modern history, is inflation. Print currency, dilute the debt in real terms. Call it quantitative easing, call it monetary accommodation, call it stimulus, but what it means for the money sitting in your savings account is this: it will buy less, significantly less. I have mapped the consequences of this choice across 5 centuries. In the 1930s, stocks fell nearly 90% from peak to trough. Government bonds defaulted. Corporate bonds were destroyed. The only people who came through with their wealth intact were those positioned in 4 specific types of assets: physical precious metals, businesses with durable pricing power, short-term government instruments, and productive land. In the 1970s, when inflation ran at 7 to 9% annually for a decade, the 10-year Treasury bond lost more than 60% of its real purchasing value. Stock investors who entered in 1968 did not break even in real, inflation-adjusted terms until the early 1980s, 13 years of apparent progress masking actual financial erosion. But those same 4 asset classes, Gold rose from $35 an ounce to $850. Energy companies with hard asset reserves saw revenues explode as oil prices surged. Agricultural land doubled and tripled in value. Short-term instruments provided liquidity at exactly the moment opportunities appeared. The pattern repeats, not because markets are conspiring, but because human behavior under monetary stress is extraordinarily consistent. We're now entering that same late stage, and most retirement portfolios in America are positioned exactly wrong for what's about to unfold. Let me tell you about a man I'll call Richard. He was 54 years old when I first sat down with him, a disciplined, intelligent engineer who had done everything his financial advisors and his culture told him to do. Over 30 years of steady saving, he had built a portfolio worth $1, $8 million. He held 60% in equities, 40% in bonds, precisely the allocation his wealth management firm prescribed. He paid nearly $20,000 a year in fees for that advice, and in return, they told him to stay the course. I walked Richard through what I'm sharing with you now. The late-stage debt cycle indicators, the housing leverage ratios, the bank exposure to instruments nobody could properly value. I told him a restructuring was coming, not as a prediction, but as a logical conclusion of where the numbers pointed. I explained that 4 specific asset classes had survived every comparable historical crisis, and that repositioning into them was not a radical move, it was the most rational one available. His advisor disagreed. They showed Richard charts spanning 4 decades. They invoked diversification. They told him my concerns were overblown, that the fundamentals were sound, and that alarmism was the only real risk he faced. Richard trusted them, and for a while that trust felt justified. By 2007, his portfolio had climbed to $2, $1 million. He and his wife began sketching out the shape of their future: a vacation property in Florida, a Mediterranean cruise, an early retirement. Life looked like it was rewarding patience. Then 2008 arrived. In 18 months, Richard's $2, $1 million became $970,000, a 54% decline. His advisor's message remained unchanged: don't panic, don't sell, the market always recovers. And technically they were right. The market did recover, but not until 2013. By then, Richard was 61 years old, and the compound time his portfolio needed to reach his retirement target had been stolen. His retirement calculator now showed an $800,000 shortfall. He pushed retirement to 65, then 67, then 70. I spoke with Richard recently. He is 72 years old and still working, not out of passion, not out of purpose, but out of necessity. The Florida home never materialized. The cruise never sailed. His golden years became an extension of his working ones. The advisor who recommended he stay the course, he retired at 58. He lives in Palm Beach. He plays golf several days a week. Richard wasn't careless. He wasn't ignorant. He followed the rules precisely as they were written for him, and those rules failed him catastrophically. That's the part nobody in the financial establishment wants to discuss, not because they're malicious, but because the conventional advice is built around average outcomes in normal cycles. And we are not in a normal cycle. There was also a woman, I'll call her Margaret, who reached out to me in 2011. She was 68 years old. Her husband had died 2 years earlier from a heart attack. She believed, quietly but firmly, that the financial devastation of 2008 had accelerated his decline. They had retired with $1, $4 million in a balanced portfolio weighted toward equities for growth. When the crisis hit, more than $600,000 evaporated. Her husband began waking at 3 a.m. to check account balances. His appetite disappeared. His health deteriorated in the particular way that prolonged stress dismantles a person. Margaret didn't write to me seeking sympathy. She wrote because she wanted to say something clearly to anyone who might still have time to act on it. The real cost of following conventional wisdom isn't measured only in dollars. It's measured in sleep lost, in meals skipped, in the slow erosion of a person you love. She told me she would have gladly surrendered every dollar of potential upside, every percentage point of market gain for the security of knowing their savings were truly protected. Her words have stayed with me because they articulate something that financial spreadsheets cannot capture. Wealth isn't just a number. It's the infrastructure of a life. It's the Florida home and the Mediterranean cruise and the freedom to retire when your body is still strong enough to enjoy it. When that infrastructure collapses, the damage is never purely financial. The purpose of the strategy I'm about to share with you isn't to make you wealthy. Wealth building is a different conversation. This is about preservation, about making sure that what you've already built survives the economic conditions that historical data, current debt metrics, and 5 centuries of documented pattern behavior all indicate are approaching. Not to scare you, to prepare you, because the 4 assets I'm about to describe have worked in every comparable crisis on record, and right now, you still have time to own them. When the machine breaks, not everything breaks with it. That's the insight most conventional financial planning ignores entirely, the assumption that all assets share the same vulnerability. They don't. In every major debt cycle collapse across the past century, 4 categories of assets not only survived, but in many cases thrived precisely because everything around them was deteriorating. Let me walk you through each one, not as abstract theory, but as concrete, actionable positions you can begin building this week. The first is physical precious metals, specifically gold and silver, that you own outright, stored in your possession or in an allocated vault account in your name. Not exchange-traded funds, not mining company shares, not certificates, physical metal. The distinction matters enormously. An ETF is a paper promise. In a genuine monetary crisis, paper promises are exactly what's being repriced downward. The metal itself is not. According to historical records, when the 1970s inflation cycle ran its full course, gold climbed from $35 per ounce to $850, a return of roughly 24 times. An investment of $10,000 in gold at the start of that decade was worth nearly $250,000 by its end. The equivalent position in the S&P 500, adjusted for inflation, yielded a fraction of that. In 2025, official market data indicates gold appreciated more than 70% and silver more than 140%. The market is already beginning to price in monetary stress. A reasonable allocation is 10 to 15% of your liquid net worth. You can purchase directly through reputable dealers, arrange allocated storage across multiple jurisdictions, or buy from local coin shops for smaller amounts. Focus on bullion American Eagle coins, Canadian maple leafs, standard silver rounds, or bars. Avoid collectible or numismatic coins, which carry inflated premiums and perform differently from pure bullion in a crisis. This is insurance. Its purpose isn't to outperform stocks in good years, it's to hold value when everything else is being devalued by monetary policy decisions made in rooms you'll never enter. The second category is businesses with durable pricing power. Not index funds, not speculative growth stocks, established companies with 3 specific characteristics. They can raise prices faster than inflation. They generate reliable cash flow, and they own hard assets or intellectual property that holds value when currency is being debased. During the 1970s inflationary cycle, companies in consumer staples, regulated utilities, and healthcare did something extraordinary. They didn't merely survive, they expanded their margins. When manufacturing costs rose 20%, a company like Procter & Gamble raised consumer prices 25%. Customers complained, but they kept buying Tide and Pampers and Gillette razors. That's pricing power. It means inflation becomes a feature, not a threat. According to publicly available dividend records, companies classified as dividend aristocrats, those that have increased dividends for 25 or more consecutive years, have demonstrated this characteristic through multiple recessions, energy shocks, and monetary crises. The list includes roughly 65 companies across consumer staples, utilities, and healthcare. A reasonable approach is to hold equal positions across 6 to 8 of these companies, allocating 30 to 35% of your portfolio. These aren't exciting. They're not the positions your brother-in-law brags about at Thanksgiving. They're the ones still standing after the excitement has destroyed everything else. The third asset is short-term United States Treasury securities, 90-day to 2-year. Bills and cash-equivalent money market funds backed entirely by government debt. This is your liquidity reservoir, your optionality, your ability to act when everyone else is paralyzed. In March 2008, investment-grade corporate bonds were trading at 60 cents on the dollar for investors with cash available. 12 months later, those bonds had returned to par, a 60% gain at minimal risk. In March 2020, when pandemic fear drove equity markets down 35% in 3 weeks, liquid investors who deployed capital near the bottom doubled it within 6 months. The fortunes made in those moments did not belong to the most sophisticated investors. They belonged to the most liquid ones. Currently, short-term Treasury yields sit at their highest levels in over 15 years, earning 4 to 5% with full liquidity and zero credit risk. That window won't remain open indefinitely. When the Federal Reserve responds to the next crisis phase with rate cuts, and according to the historical pattern, it will, that 5% becomes 1% or lower. We allocate 20 to 25% here through Treasury Direct, the government's free direct purchase platform, or through Treasury ETFs available through any standard brokerage account. The fourth category is productive real assets, farmland, income-generating real estate, and infrastructure that produces what people need, regardless of what currency is doing. During the Great Depression, farmland held its real value while financial assets collapsed, because food demand does not disappear in a monetary crisis. In the 1970s, agricultural land doubled and tripled as food prices surged with broader inflation. Allocate 10 to 15% through farmland-focused REITs or diversified real estate investment trusts with long dividend track records. The key characteristic is that these assets generate income from tangible production crops, shelter, energy that cannot be printed into existence. Understanding the four assets is the easy part. Most people who watch a video like this will nod along, find the logic compelling, and then do precisely nothing. Not because they disagree, not because they lack the means, but because inertia is powerful, because change is uncomfortable, and because every financial advisor they trust is quietly incentivized to tell them to stay the course. Advisors earn fees on assets under management. They earn nothing when you move 15% of your portfolio into physical gold stored in an allocated vault. The advice you receive is shaped, often invisibly, by the structure of those incentives. So let me give you a concrete system, not a concept, not a philosophy, but a step-by-step sequence you can begin executing this week, regardless of your portfolio size or current allocation. The first step is to assess your timeline honestly. How many years separate you from the moment you'll need this money? If you're in your mid-30s with a 25-year horizon, you have the flexibility to reposition gradually over 12 months. If you're in your late 50s with retirement 7 years away, the urgency is higher. A 3 to 6 month repositioning timeline is more appropriate. The closer you are to needing the capital, the less time you have to recover from a major drawdown, and the more critical it becomes to act now rather than monitor the situation. The second step is to eliminate the most vulnerable positions first. Speculative holdings, momentum stocks with no earnings, trend-driven cryptocurrency positions, growth companies trading at valuations that assume a decade of uninterrupted expansion. These are the positions that get destroyed fastest when liquidity contracts and risk appetite collapses. Sell them first. Then begin systematically trimming overweight index fund exposure over 3 to 6 months. Don't attempt to time the perfect exit. No one can. The goal is systematic reduction of vulnerability, not perfect market timing. The third step is building the 4 buckets deliberately and gradually. In the first month, purchase your initial precious metals position. Start at 5% of the portfolio, a few gold bullion coins from a reputable dealer, and open a Treasury Direct account. In the second month, research dividend aristocrats and initiate your first 2 positions in pricing power businesses, established consumer staples or healthcare companies with 25+ years of consecutive dividend increases. Move 10% of available cash into short-term Treasury bills. In months 3 through 5, continue adding to each bucket incrementally more pricing power businesses. Increase gold and silver allocation toward the 10 to 15% target, and initial real asset exposure through a farmland or diversified real estate REIT. By month 6, conduct a full portfolio review. At this point, you should have 70 to 80% of your holdings positioned across the four defensive categories. The deliberate, gradual nature of this approach serves three functions simultaneously. It averages your entry points rather than requiring you to predict market bottoms. It gives you time to learn, adjust, and refine as you go. And it reduces the emotional strain that causes most investors to abandon strategies before they've had time to work. A system executed consistently at 80% of its theoretical optimum vastly outperforms a perfect strategy abandoned under pressure. The fourth step, and arguably the most difficult, is to ignore the noise during the repositioning period. While you're building these positions, markets will likely continue to fluctuate. There will be weeks when your previous holdings would have generated returns your new positions did not match. Financial media will run segments about bull market resilience. Colleagues will share portfolio screenshots. The psychological pressure to reverse course will be real. Resist it. The repositioning isn't based on what happens next quarter. It's based on where we are in a structural, multi-generational economic cycle. Short-term performance comparisons are entirely irrelevant to that calculation. Here's the honest truth about what happens next. According to the historical pattern I've studied across 5 centuries of debt cycles, we are in the late stages of a transition that does not resolve quietly. It resolves through a transfer of purchasing power, of real wealth, of financial security from those holding the wrong assets to those holding the right ones. That transfer is not a prediction. It's a documented recurring feature of how long-term debt cycles end. The 1930s, the 1970s. The pattern is not identical each time, but the mechanism is consistent. What I'm asking you to do this week is simple. Open your portfolio. Look at every position. Ask one question about each. If inflation accelerates and monetary stress deepens over the next 5 years, will this holding preserve my purchasing power? Mark the ones where the honest answer is no. Then make a written plan with dates, with allocation targets, with the specific steps you'll take over the next 3 to 6 months. If you found this analysis useful, share it with someone you care about who is approaching retirement. Leave a comment below with where you are in your repositioning process. I read them. And your question may shape the next video. The window is real. The timeline is finite. The 4 assets are known. What happens next is entirely your decision.